Hello and welcome to Big Deal. I'm Nisha Poddar, and today on Big Deal, I have a team of experts to really discuss the return of the startup IPOs in the stock markets. A lot has happened over the last few years and many learnings, and whether they can make an entry and in what form. That's what we're going to discuss with the team of experts joining me. Let me welcome on the show Gaurav Sood of Avendus Capital, Amrit Acharya of Zetwerk, and Gautam Patel of Z3Partners. Now, gentlemen, welcome to CNBC-TV18. Gautam is sitting right here with us in the studio. Let me begin with you. Gautam, you've seen several stages of the startup's life cycle. You've seen how the IPOs panned out in the last few years, and 70% of the fundraise done through the IPO was to give an exit to the VCs like yourself. Is the VC community right now worried with the way the valuations have dropped from the IPO figures to now, especially in the equity markets, and the kind of preparedness that we are seeing in terms of valuation expectation of the aspirants?
Yeah, Nisha, thank you for having me on the show. Of course, the VC community is very cautious, concerned right now, given the macro conditions of tech markets across the globe. But more importantly, how some of the startup IPOs have performed in the last 4 to 5 years.
Yes.
So if you see that, they've been down below their IPO prices from 30 to 70%, which is worrying. And there are a lot of irate retail investors out there who are looking for better performance. So my sense is that's one. But the other concern is, for us VCs, is effectively in the next the next 12 to 24 months, with valuations being compressed, we're trying to figure out for some of our better performing companies what's the right timing for that.
Right. So timing is also equally important, and preparedness at the time of really coming to the market. But let me just focus on one summation of the data that we have got on the current price to book value and how it has really dropped from the time of the IPO for most of the companies in the digital space. So we have summed it up and we'll be flashing that on the screens. Now, coming to Gaurav. Gaurav, you've seen many ECM cycles, you've done many IPOs, and now you've joined Avendus, which has been one of the stalwarts in fundraising for stage A, B, C, D for the startups, and now looking at the IPO market and ECM advisory with you at the helm of it. So Gaurav, how do you see what has panned out and the valuation drop? What does this signify for startup IPOs, and what will be your strategy at Avendus now?
Sure. Thank you, Nisha, for having me here. So, obviously we've all seen how the capital markets have performed in the last couple of years, especially 2021, which was the watershed moment for Indian equity markets, especially the tech sector, where we saw 5 or 6 of some of the large tech unicorns come and list and get a phenomenal response from the public market. So clearly, couple of trends that we saw in 21, and those trends we believe will continue not just in 23, 24, but beyond. There are a lot of institutional investors that are believers in these businesses. It is not just that it was a one-time phenomenon. We clearly believe, and at Avendus, we work a lot, as you mentioned, we work a lot with a lot of these companies on the private side. So there is a lot of belief in the ecosystem. We believe that these companies are here to stay, and a lot of them will find acceptability in public markets. Of course, valuations have changed, and things are different from where we were in 21. But that's not just a function of how these companies, not just about the IPOs, but it's also the way markets are. Markets are clearly different from where we were in 21, which was a liquidity-driven environment where issuers were getting top dollar valuations. Of course, things have changed. Today we are in a heightened monetary tightening regime, and with the way interest rate cycles are, obviously valuations have come off. Cost of capital is significantly higher. So we should not, it's not just about tech IPOs. Overall, there is it's a different market. But if you ask me, will there be belief in these companies if more such companies come to the market? The answer is a resounding yes. We have interacted a lot with private companies in the last 6 to 9 months, who are looking to go public maybe in the next 2 or 3 years, or maybe some of them will go public in 5 years. But there is obviously a lot of.
Right, right. So it's a different market that's coming out loud and clear from what Gaurav is saying. But Amrit, I'll come to you for the toughest question. You are now representing the entire startup founder community. And how do you see this particular situation in terms of valuation drop and the confidence level of the founders to raise funds and give exits to their VC investors?
Yeah, I mean, there are many things that are under the company's control and some that aren't. I mean, I fundamentally think that IPO is less a exit, but more like the beginning of a new journey. It's a milestone in the company's, and depends on the timeline of the company that has its mind. Like for us, we think in decades, and definitely like when we think about an IPO, it will be not. I mean, one part of it is of course, helping out shareholders who have return expectations, but it is also to bring in a new pool of shareholders who can be shareholders in the company for the next 10 years. Right? So, I mean, that's how we would think about it. And of course, pricing is a function of many different things, but I think few things that companies can do starting today. I mean, the thing, our biggest takeaway from seeing other companies in the public markets is that public markets really value predictability. How accurately can you forecast your company's performance over the next quarter and the next few quarters, and then how true are you to that performance, that whatever you forecast. And forecasting is a muscle that is needs to be built along with all the other muscles that companies do build over a period of time. I think that's one takeaway we are having, that when we give guidance to our existing shareholders and new shareholders, how good is our guidance and how accurate is how do we live up to that guidance over a period of time?
Right. So, Amrit, the biggest takeaway from what you said is that you are looking at more long-term focused investors, because we have seen in the last cycle that there was a lot of pressure from some of the investors for an exit. So you don't want that kind of a pressure as well. So that's one important takeaway. But, Gautam, this has been a talking point in terms of the valuation, whether we have left enough on the table. While the overall market has dropped, the digital space has significantly underperformed the rest of the market and the age-old blue chip and the well-settled brick and mortar old economy companies. So when we look at this particular comparison, how do you compare the valuations that are trending right now? And I'm not just talking about the public market, but even in the private market, the valuations have dropped significantly.
Yeah, sure, Nisha. So I believe, India is probably one of the most exciting destinations for digital and tech investing today. The question is, we call it a 95 and 5 game.
Yes.
There are 95% of the companies which are suboptimal and 5% which are the greatest companies we're going to see out of this country and globally. The question is that we are coming from a recovery that our companies, our startup IPOs were trading at 30 to 50 times sales.
Yeah.
That's not sustainable, and especially that's only for the market leaders. Now, if you look at the multiples, they've compressed significantly to 5 to 10 times revenue. So effectively, but even if you see the better performing startup IPOs in the last 5 years,
yes,
these guys have performed at 5 to 8,000 crore market cap,
yes,
at 1,000 crore revenue number. So we believe there's a fresh pipeline of good IPO candidates from the startup community at these metrics, which is approximately 5 to 8,000 crore market cap, but at 1,000 crore revenues, with strong unit economics, good governance, and good capital efficiency.
And clear path to profitability, if they are not already profitable.
Exactly. So when I mean strong unit economics leading to either profitability in the next 24 months or already profitable.
Right. So that has really seeped in. Let me ask somebody who's been now speaking and probably pitching and also speaking to the investors. So Gaurav, what do you think? Has the understanding of lower valuations more aligned with the reality really seeped into the minds of the founders and VC community? First, on one hand, and second, how are institutions really, the domestic institutional investors, looking at these IPOs? Once burnt, are they ready to take another bet?
Sure. So, firstly, on the question how the companies are thinking, when we talk to companies, nobody is really talking about what valuation we will get in the market. I think people are more concerned and cognizant that they want a successful IPO. And what they are working towards is getting a high quality successful IPO done in the market. And for that, issuers today are preparing 2 to 3 years before the IPO. So they are getting processes in place, systems in place, board in order, full management team, which will run the company, not from an IPO process, but even after. Valuation is, most people who are, who've seen the cycles do understand it's a byproduct of not just how the company is, how the business is, strength of management, but a larger function of how the markets are at that point of time. A lot of these companies which listed in 21 were resounding successes. Most of them were 20, 30x subscribed, got phenomenal valuations, but same businesses in this market would not have got those valuations. So issuers are preparing for successful IPOs and life in the aftermarket. They are aware that this is a decision that they cannot go back on life. Once you are listed forever. And they want us to be fully prepared to live life in the aftermarket. Valuations is a function of sentiment at that point of time. So I think people are cognizant that it's not what happened in 21 is a template for the years to come. On your second question on institutional investors, of course, there was a little bit of a, for the lack of a better word, a little bit of a FOMO in 21, and people felt that this is a big tech wave, and everybody sort of participated. I think this time the barriers to come into the market are high. Investors will ask tougher questions, and specifically on things like paths to profitability. In the past, you could have gotten away with an ambiguous answer to that, but now investors are much more specific in those questions. If you're talking about a path to profitability, then the point is whether it's next 4 quarters, 6 quarters, or 8 quarters. So that is one question that will, but otherwise, as my colleagues mentioned, clear, focus is on unit economics and operational efficiency. So investors have clearly put the bar higher than last time. That's something which I would like to share.
All right. So very important takeaway that investors have put the bar very high. But I would say that the valuation is also a mechanism of also calculating based on the last round. And the last round for most of these companies had been done at a very high valuation. So a lot of companies will find it very difficult to either raise funds or give any exits at the current realistic position in the market. And that is becoming a catch-22 situation. On that note, we'll slip into a short breather, give it a little more thought, and we'll come back with more discussion points on this subject on Big Deal. Stay tuned. Welcome back. You're watching Big Deal, and we are discussing the return of startup IPOs and whether there is market appetite and what is it that the startups also need to learn from the past experience. Amrit, being a founder yourself, from the last experience and the wave of IPOs that we saw, there are many learnings. What are your top picks in terms of the lessons for your own self?
Yeah, I can think of 3 things. Like to begin with, start the process early. This is not something that we can wish today and execute in a month or a year. Sometimes the building blocks take time. Second thing is, I think even, and this is something again linked to the first one, where the way IPO process works, there's a roadshow, and the roadshow is when you start communicating with investors, telling the story of the business, etc. But often that is also not enough time. Sometimes it's good to spend many cycles with investors, maybe like a year or 2 before you're ready to go public. Start educating more and more people about what the company is and what the business is likely to be, so that they can also track you over a period of time and see how you've performed versus when you spoke to you 1 year ago to today. Because the IPO roadshow is a very short, compressed time period. It's a little bit like arranged marriage in a very short span of time.
Yes.
Where you want to spend more time on both sides.
All right.
Those are the few things, yeah.
All right. So the journey begins after the listing. A lot of, startups have really realized that. But Gautam, it is very critical to have the, capital market, the stock market as an exit option. I know at least 7-8 years back, the entire VC community was clamoring for this opportunity to be there. But when we got it, there were some missteps that did take place. Now, how are you preparing your portfolio companies for your own sake for getting the right hefty returns from the IPOs?
Yeah, sure. So, we take this part very seriously. We actually spend a decent amount of our time with our portfolio companies, and we have a playbook. And some of this is something that, is not very apparent. So one of them is the discipline around MIS reporting versus end financial year reporting.
Yes.
Effectively, in the MIS, people are using revenue, GMV, definition of GMV versus net sales, definition of ARR in SaaS companies versus live ARR, EBITDA versus adjusted EBITDA, and EBITDA in some cases instead of return on capital employed. So this is the discipline that we need to put together.
Right.
Number two is, related party transactions. So we need to educate our founders that there are issues around related party transactions. They need to be transparent about that.
Yes.
Number three is effectively consistency and sustainability of unit economics and metrics. 6 to 8 quarters prior and 6 to 8 quarters post the IPO.
Right.
That's very important. So these are the 3 or 4 things that we do. And the most important is promoter ownership structures, whether in Indian holdcos or foreign subsidiaries, and whether that is compliant with the RBI and FEMA.
Right. So basically complying with most of the norms and be ready for the public market. That's what you are advocating to the portfolio companies. But Gaurav, how is the pipeline of aspirants looking? And why I call it the pipeline of aspirants, because a lot of companies, a lot of names which were there a few weeks back are non-existent because they do see that the valuations do not match up. So how are you seeing the pipeline and the preparedness, and how many could really fructify?
On the pipeline, as you mentioned, of course, there was a larger pipeline end of last year and maybe start of this year. Some of them have decided to postpone, but still there are, I would say, at least a handful of you who are still going ahead and have filed, and hopefully in a decent and stable market. As Amrit mentioned, that IPO needs a stable market and predictability. Some of them could go through, but on a more, sort of a long-term basis, there is a healthy pipeline of companies that will tap public markets. We expect that in the next 5 years, at least 20-25 companies will come from the tech space, if not more. And those will be across sectors. It will be consumer tech, fintech, on logistics, across tech sectors you will see, because these are businesses which are here to stay. And we take a lot of confidence from secondary market and private capital markets. So we have actually both the lenses here in Avendus. On the secondary market side, about $3 billion worth of secondary market blocks on the tech side have traded, which have got a strong response from institutional investors. And secondary markets are precursors to primary markets. So if there is such strong appetite for the same 5 companies in the secondary market, we think there are more believers when new companies come for IPOs.
Yes.
And even on the private side, we are seeing very strong action in some of the large companies. Recently, we did a large fundraise where a sovereign wealth fund invested in a large consumer tech company for about $500 million. So clearly, there is appetite, there is capital available, but obviously the bar is high. Only the quality companies will get the top dollar valuation and top quality.
Right. Its quality is one thing, but Gaurav, what I have also identified is that now that the valuations have dropped at these levels, there are still buyers. But Gautam, I want to pick your brain on one important aspect regarding this, and it is that there is still money chasing some of the digital companies, and some of the sectors are doing much better than the others when it comes to public market approach. Which are those spaces which will still have a calling?
Yes, thank you for asking that question, Nisha. We are particularly excited about the SaaS companies that are being built out of India. My dear friend Rajan Anandan and us, I believe that in the next decade, between 10 to 15 years, we're going to have about 50 to 100 of these SaaS companies go public on the Indian exchanges.
Right.
The Indian SaaS companies, are more capital efficient if you compare them to the US companies from a capital raise to a revenue perspective.
Right.
Number 2, they are inherently got higher margins 50 to 80% gross margins. Number 3 is their addressable markets. Their GTM, go-to-market, is India, Middle East, Southeast Asia. And you can actually build 50 to 75 million ARR companies.
Yes.
And hopefully a bunch of those will go public in the next 10 to 15 years, which we're quite looking forward to.
All right. So Amrit, Zetwerk falls into that category or not, Gautam?
So I'm very biased. I've been blessed by having a 6-year association with Off Business.
In the similar space.
One of the co-founders of Off Business helped start Zetwerk. So I'm of course biased towards Off Business, but I think Zetwerk has got a good shot as well.
All right. So Amrit, there's a backing for you. So tell us, what is the timeline for your IPO?
No, we're still some time away. We are still a 5-year-old business. I think sometimes, even for me, it takes me a moment to recognize that this is actually, we started our company in April 2018. So this month we'll be celebrating our 5-year anniversary.
Right.
So we have come a long way. We still have a long way to go.
All right.
Exploring international markets, we're exploring new categories. So
right. All right, all the best for that, Amrit. And thank you so much, all of you, Gautam, Gaurav, as well as Amrit, for joining us on this riveting conversation. So startup IPOs, whether they can make a comeback and which ones will do well and which ones won't, and what is the market appetite like. This is what we discussed, and this is evolving as the market evolves and macros evolve. So we'll keep an eye on that as well. But that's a wrap on this edition of Big Deal. Thanks so much for tuning in.